Assalamualaikum warahmatullahi wabarakatuh. I'm going to present the financial plan of Dzana Enterprise. Actually, I'm going to present the second stage of our consultation work engagement with Dzana Enterprise. This is the preliminary pre-report that we have done earlier. In this report, we examine the background information of the company, identify changes faced by the firm, and calculate weighted average cost of the firm, which is 90%. Building on those findings, this report intends to dig deeper and aims to prepare 5-year forecast cash flow statement and ultimately determine the worth of the firm. The attention is to help and provide our client with a clear understanding on how valuation works, the method available, and the implication of the result for strategic planning for long term. Business valuation is not merely a number problem, but it's involved combination of financial analysis, economic factor, and judgmental approach towards the future of the business itself. For a small business like Dzana Enterprise, valuation is very important actually because it's heavily depend on the government contract and face both opportunity and risk in its sector. By using cash flow projection and applying valuation technique, we can estimate the worth of the business today and provide recommendation for sustainability growth for Dzana Enterprise in the future. We can help them to make a certain decision and a great decision for their own business.
Okay, for the first one is business valuation process. So this slide outlines the structured approach we use to estimate the value of Dzana Enterprise. The process follows 7 key steps to ensure the valuation is accurate, relevant, and aligned with the company's financial reality. For the first step, we begin by clarifying the purpose of the valuation. So in this case, it is for consultancy advice. So to support financial planning, investment decisions, and also assess long-term sustainability. So the scope covers the entire business rather than portion of shareholdings. That means we are evaluating the Dzana Enterprise as a whole, including all assets, liabilities, and future earning potential. Second step is data gathering. So we collected both quantitative and qualitative data. So this includes the 2024 financial statements, profit and loss, balance sheet, and also trial balance, as well as contextual factors like government contracts, tenders opportunities, and also funding sources. So these inputs helps us to understand not just the numbers, but also the business of the environment Dzana operates in. The third step is adjust financials. So we then refine the financial data by removing one of our discretionary items such as donation and also owner withdrawals. So these items do not reflect the ongoing operations of the business. So by focusing on recurring revenues and expenses, we ensure that the projections represents the true earning capacity of Dzana Enterprise. The fourth step is to choose valuation method. So we have 3 valuation methods, which is asset-based method, market-based method, and also income-based method. So asset-based method gives a liquidation value based on assets. The market-based method compares Dzana to similar businesses using peer multiples. And lastly is income-based method. Income-based method estimate future cash flow and discount them to present value. So since Dzana relies heavily on government contracts and predictable cash flow, so the income-based method, which is discounted cash flow, was selected as the most appropriate.
Right now, let's move on to the next method, which is apply method. So, the chosen methods will now be carried out on the data. In this case, Dzana Enterprise is necessary to prepare their 5-year projected cash flow statement. Discount for this projected cash flow will be using their WACC of 90% and find their terminal value. The asset-based and market-based methods were acknowledged but not applied in detail, as they were less relevant to the Dzana Enterprise context. Moving on to the next method, analyze and conclude. At this stage, the findings obtained from valuation are then analyzed. For Dzana Enterprise, the discounted cash flow method produced an estimated business value of 746,000 ringgit. This amount was checked with its equity and profits to ensure that it was rational. It was thought that the DCF valuation provided a realistic and credible estimate of worth. The last one is report. The last stage of the valuation process is that the calculation of value must be documented. This report serves that purpose as it clearly states the assumptions, method approaches, calculations, and conclusions. When it comes to the value of Dzana Enterprise, the report not only provides a numerical amount, but also outlines the reasoning behind the choice of method and highlights strategic recommendations for the future.
Next, I will continue with business valuation method.
For Dzana Enterprise, we considered three main valuation approaches: asset-based, market-based, and income-based valuation. First, asset-based valuation. The asset-based valuation method determines the value of the business by calculating the fair market value of its asset and deducting its liabilities. This method is commonly used in liquidation scenarios where the focus is on what the business earns rather than what it can earn in the future. It works best for asset-heavy businesses such as manufacturing firms. For Dzana Enterprise, this method includes cash holding of RM228,106, including savings and petty cash, the tangible asset and owner's drawing, less current liabilities of RM2,850. Using this approach, the estimate value is approximately RM100,494, which is close to the equity reported in the balance sheet. However, this method significantly undervalues Dzana Enterprise because it ignores the company's future earning potential. Dzana Enterprise strength does not lie in physical asset, but in its ability to secure government tenders and generate recurring income. Therefore, while the asset-based method provides a baseline value, it does not reflect the true economic value of the business. Second, market-based valuation. The market-based valuation estimates business value by comparing it with similar companies in the same industry. This method typically uses valuation multiples such as price to earning, price to sell, and enterprise value multiples. It reflects market sentiment and industry benchmark, making it useful where comparable companies exist. However, in the case of Dzana Enterprise, there are notable limitations, such as the company operates in a niche sector heavily influenced by government regulation. Second, comparable firms are difficult to identify, and third, small businesses face unique risks that are not reflected in industry average. As a result, while the market-based approach provides useful reference point, it cannot be relied upon a standalone valuation method for Dzana Enterprise. Lastly, income-based valuation, discounted cash flow. The income-based approach values a business based on its ability to generate future cash flow. The discounted cash flow method projects future cash flow and discount them to the same value using the company's weighted average cost of capital. This approach captures both profitability and risk, making it highly suitable for going concern businesses. For Dzana Enterprise, the DCF method is the most appropriate valuation approach because the company generates stable and recurring income from government contracts. Its cost structure is predictable and transparent. Future cash flow can be reasonably forecasted. By projecting 5 years of cash flows and discounting them at a WACC of 19%, the estimated present value of the business is approximately RM103,151. This valuation reflects the true earning potential of Dzana Enterprise, rather than just its asset-based and market comparisons. In conclusion, while asset-based and market-based valuation provide useful supporting insight, the income-based valuation, specifically the discounted cash flow method, offer the most accurate and meaningful estimate of Dzana Enterprise value. This approach best captures the company's long-term profitability, competitive advantage, and growth potential, making it the most suitable method for decision-making and investment purpose.
Next, I will be present about forecasted cash flow. So this project requires the company to purchase new packing machinery costing 50,000. So the machinery will be depreciated using the straight line method at 10% per year. So this means the annual depreciation expense is about 5,000. At the end of the project, the company expects to sell the machinery for 25,000, which will be treated as salvage value. So the applicable income tax rate is 19% based on the taxable income of 75,536. So moving on to the revenue and expenses projection. Revenue is expected to grow by 15% annually starting from 2025. In 2025, projected revenue is 3,098,299, with expenses increasing by 10% to 234,878. In 2026, revenue increased to 3,563,044, while expenses rise to 258,366. For 2027, revenue is projected at 4,097,501 and expenses increase to 284,202. In 2028, revenue continues to grow to 4,712,126 with expense at 312,622. So for 2029, projected revenue is 5,418 and 945, and expenses increase to 343 million and 884. Lastly, in 2030, revenue is expected to reach 6,231,787, with expenses continuing to grow at 10%. So overall, The consistent growth in the revenue compared to the expenses indicates that the project is financially viable and has strong long-term potential.
Okay, so for this project, we use the constant growth model to estimate the terminal value of the business. The discount rate applied is 19%, while the perpetual growth rate is 8%. This model helps us project future cash flow and adjust them based on risk. The terminal cash flow represents after-tax non-operating cash flow in the final year, which usually comes from asset liquidation. The total initial investment required in year 0 is 75,000 ringgit. This includes 50,000 ringgit for equipment and 25,000 ringgit for the net working capital. This investment is necessary to support the expansion of operations and serve as the foundation of future cash flow. This project shows strong and consistent growth in operating cash flow over 5 years. In the first year, earnings before interest and tax amounts to 305,046 ringgit, with tax savings from depreciation of 950 ringgit. The net operating cash flow in the year 1 is 305,996 ringgit. By year 5, the net relevant cash flow increases to 602,151 ringgit, showing steady growth and improving profitability. The main drivers of these positive cash flows are rising after tax profits and tax savings from depreciation. After tax profits increase from 310,000 ringgit in year 1 to 547,000 ringgit in year 5, reflecting strong business performance. Depreciation of 5,000 ringgit per year provides annual tax savings of 950 ringgit, which reduce tax expenses and increase the net cash inflows. At the end of the project, terminal cash flows are generated from asset disposal, tax effects, and the return of working capital. The machinery is expected to be sold at 25,000 ringgit, which is 50% of its original cost. This creates a tax effect of 5,000 ringgit. In addition, the net working capital of 25,000 ringgit is fully recovered, contributing further to the terminal cash flow. When we combine the operating cash flow and terminal cash flow, the net relevant cash flow in year 1 is 305,996 ringgit. These amounts continues to rise each year and reach 603,151 ringgit in year 5. Overall, this is an increase of 237,150 ringgit across the project period. This investment demonstrates strong capital efficiency. With an initial investment of only 75,000 ringgit, the project generates more than 3,000 ringgit in operating cash flow in the first year. This indicates high operating leverage and effective use of resources. Furthermore, the full recovery of working capital at the end of the project reduces long-term risk. In conclusion, the project shows consistent growth in cash flows and strong profitability throughout its life. The terminal cash flow significantly enhances the overall valuation. The constant growth model supports the long-term sustainability of the business. Therefore, this project is financially attractive and the expected returns clearly justify the initial investment.
Now let's look at the discussion of the results. Based on the forecasted cash flow and business valuation of Dzana Enterprise, the project of the acquisition of the new asset requires a total initial capital outlay of 75,000 ringgit in year 0. The equipment acquisition represents 50,000 ringgit, while an additional 20,000 ringgit is allocated to net working capital to support the operational requirement of the expanded capacity. This issue is crucial for determining the financial viability of the project as it sets the foundation for future cash inflows and potential returns. The project demonstrated robust and consistently growing operation cash flows throughout 5 years of operational life. For the first year, 305,046 ringgit is calculated for earnings before interest and taxes, with tax savings from depreciation contributing an additional 950 ringgit. This results in net operating cash flows of 305,996 in year 1. The cash flows exhibit a steady growth trajectory by reaching 603,151 ringgit for net relevant cash flows in year 5 before considering terminal value adjustments. This growth pattern reflects the underlying business expansion and increasing profitability from the investment of buying new equipment. Several factors that drive this positive cash flow performance are the after-tax increase in profits growing substantially from 310,046 ringgit in year 1 to 547,201 ringgit in year 5. indicates strong operational leverage and market demand. The consistent annual depreciation of 5,000 ringgit provides predictable tax shields of 950 ringgit annually based on 90% of the tax rate of the company. The consistent annual depreciation caused a reduction in operating expenses, which lead to a decrease in profit. Tax that being paid based on profit is low lead to tax saving. This results less cash outflow for the company. This tax efficiency enhances the project net cash generation capability. Next, based on Dzana Enterprise, terminal cash flows are calculated based on the scrap value of an asset, tax effect from disposal, and the return of net working capital. In the analysis, the machinery market value at disposal is estimated at 25,000 ringgit, representing 50% of its original cost, which suggests reasonable residual value retention. This results in a tax effect of 5,000 ringgit for the final year, contributing to the terminal cash flow. When combining the initial investment with the operating cash flows and terminal cash flow, the net relevant cash flows are calculated. In year 1, the cash flow of 305,996 ringgit, which includes the operating cash flow, subsequent years shows a steady increase in these values, with the net relevant cash flows reaching 603,151 ringgit by year 5. The difference between the relevant cash flow of year 1 and year 5 is 237,155 ringgit. The valuation employs the constant growth model with a discount rate of 19% and perpetual growth rate of 8%. This model helps to estimate the terminal value of the business by projecting the future cash flows and adjusting for the risk-adjusted discount rate and growth assumptions. The terminal cash is factored based on the after-tax net operating cash flow for occurring in the final year of a project. It is usually attributable to the liquidation of the project. The machinery investment demonstrates efficient capital development that generates substantial returns on invested capital. The relatively modest initial investment of 75,000 ringgit, producing over 300,000 ringgit in year 1 operating cash flow, suggests significant operating leverage benefits. The complete recovery of working capital at project and enhance overall returns and reduce permanent capital commitment. In conclusion, the business financial outlook presents attractive profiles with growing cash flows over the project life. The terminal cash flow at the end of year 5 contributes significantly to the valuation, suggesting the project will generate returns that justify the initial investment. The constant growth model further strengthens the valuation considering the long-term growth assumptions. The overall projection reflects a profitable venture with a positive cash flow trajectory.
In conclusion, Dzana Enterprise has a realistic estimation of the firm's current value and has given supplier valuable insight for future planning. To increase business value, Dzana Enterprise should focus on diversity its revenue base, minimize its finance costs, and maintaining operational efficiency. The supplier will become more sustainable in the competitive environment of the market with such strategy. Based on the financial plan, we conclude that Dzana Enterprise value is from its ability to generate future cash flow from government contract rather than its tangible asset. The sensitivity analysis also showed that the valuation is highly dependent on assumption about growth and discount rate, thus emphasize the importance of strategic management in improving financial performance.